Hey, Bowtie Nation, Joseph Hogue here. Thank you for coming to us with another Monday live stream. We try doing these stock market lives every Monday at 9 a.m. Eastern. Get you ready for what's in ahead for the stock market this week. Some stocks I'm watching, as well as what you need to be watching for. Thank you for joining us again. Love doing these, just a little bit more face to face than we get with the regular videos. So I already see some Bowtie citizens, citizens of the Bowtie Nation there in the chat. Let me know where you're coming to from out there in the Bowtie Nation, and we're gonna get started because it is an important week. Last week we did have the second straight week of gains. Something we've been talking about over actually the last couple of months here is that sell the rumor ahead of the Fed rate hikes and then buy the news. So investor sentiment is higher right now. It is positive. The momentum is there for the market. Because I think investors, like we've been talking about, are coming to the realization that interest rates really aren't going to kill the stock market. Okay, even with a quarter basis point hike last couple Wednesdays ago by the Fed, and with with maybe even a half basis point hike coming at their next meeting, interest rates are still very low, and it's not going to kill the stock market. And in fact, investors are really climbing that wall of worry, as they say, about interest rates. Over the last 3 or 4 months, investors have been worried about the rate hike cycle, what it means for stocks. Typically it is one of the indicators, one of the previews to a stock market crash or lower stock prices, but maybe not in the way that a lot of investors think. So I want to point that out, and I want to look at a graphic here that I found over the weekend, because it really does highlight how well stocks can do while the Fed is raising rates. So we have here a infographic here on Visual Capitalist, great infographic that they put out, how asset classes have performed over rate hikes. So what they did, they took 3 periods here: June 99 through June 2000, June 2004 through July 2006, and then December 2015 through January 2019. Now, during these 3 periods, the Federal Reserve was increasing interest rates. Okay, all 3 periods, rate hikes were going on. And so they kind of looked at the asset class returns, all the way from municipal bonds, short-term bonds, long-term bonds, high yield, bank loans, large cap value stocks, large cap stocks, REITs, so real estate stocks, gold, large cap growth stocks, so your growth stocks there, developed country stocks, ex-US, so that's going to be things like developed Asia, Europe, and then global commodities, right? And what you see here from the graph, and we're going to look at the table here to make it a little bit clearer because this graph can be kind of busy. But what you see is it's been almost unanimously good, right? You've got the I guess turquoise. The turquoise color is the period from 99 through June 2000. Okay, so a fairly short 1-year period where the Fed was raising rates there. From June 2004 to July 2006, so about a 2-year period there before the crash of the housing bubble, right? The Fed was raising rates. And then for about 3 years, from December 2015 through January 2019, that's the yellow bubble. And you see, I mean, here's the break even, or here's the zero, and these are all annualized returns. And for the most part, almost all of these are above that zero line, above the negative returns. We just had 3. Here in the 1999 through June 2000 period, when the Fed was raising rates, you had high yield bonds here was a negative 1% annual return. Large cap value stocks was a negative 1.4, and then REITs, so real estate stocks, was a negative 0.6%. So even then, even when stocks, those 3 assets or sub assets did go down during that 1 period, it wasn't a huge sell-off. It wasn't a crash. For the most part, you see here the averages in these diamonds was unanimously good, even for bonds, which is surprising because most people think that as interest rates go up, bond prices go down, and that tends to be correct. But what they don't understand is, and with stocks as well, is a lot of times, like we've seen over the last few months, stocks and bonds have sold off so much before the Fed starts raising rates. Okay, again, you get that sell the rumor idea, the sell the rumor tendency by investors to rush out of stocks, to rush out of bonds. Interest rates go up, and you get negative returns actually before the Fed starts raising rates, and that sets us up for the buy the news kind of mentality. So when the Fed does start raising rates, then interest rates are already pretty high. So bond prices have come down, and bonds actually do well. Bonds actually post a positive return when the when the Fed is raising rates. Stocks as well. Stocks tend to post a positive return when the Fed is raising rates. I'm going to scroll down here and just scroll down to the table because it's a little bit easier to look at, a little bit easier to see the numbers. You could see the three times. We'll increase this a little bit. You can see the 3 periods that the Fed was raising rates, the asset classes on the left here, and then the average all the way to the right. And the averages are all positive. The average over all 3 of those periods. Now, obviously, you want to look at these in a little bit different context, okay? Where we were at in the economic cycle, what was going on, because they are different cycles. They were different times, different periods of Fed rate hikes. We only had 1 year of Fed rate hikes here in 99 to 2000. And obviously the market started cracking just before the Fed stopped raising rates. In fact, the Fed stopped raising rates at that period because the market was falling, okay? And that's why you got these negative returns on high yield bonds, large cap value stocks, and real estate stocks. Those started falling apart earlier than the general market. Here in June 2004 to July 2006, a 2-year period where the Fed was increasing rates, and all these assets or all these sub assets are positive. In fact, we had a 24% return on gold and REITs over that period. Real estate stocks, the real estate bubble was still inflating while the Fed was raising rates. So you cannot be too worried about higher interest rates, about raising rates, because you could miss out on a lot of returns here. What isn't shown here, and what I'm actually working on a video that's going to come out in a couple of weeks here that I'm going to show you is what comes after the rate hike cycle, okay? Because we know that's really where investors should be worried at right now, okay? But that's still probably a year and a year out, 2023, maybe even 2024, before you really have to worry about those higher rates leading to some kind of a recession or stock market collapse, okay? And what we're going to find actually is in the 1 year period. In the 1 year period after the Fed stops raising rates, stocks and bonds tend to do positive returns as well, even up to a year after this Fed stops raising rates. And this is all kind of intuitive if you think about it. If you think about why the Fed is raising rates and what that means for stock prices and for other assets. Okay, the Fed starts raising rates because it's trying to cool down inflation because the economy is growing too hot. Okay, the Federal Reserve, the central bank of the U.S., has 2 mandates, only 2 rules that it lives by. Okay, low unemployment, but also low inflation. Okay, and those are kind of countervailing facts, right? Because you can have a really super low inflation, low employment, or low unemployment, really great jobs picture, economy is buzzing along, but that's generally going to mean a little bit higher inflation. Okay, so they have to balance that with interest rates. If the economy gets too hot, starts raising that inflation, those prices start going up. They have to raise rates to bring inflation down a little bit, even if it levels off the growth in employment. Okay. On the other side, if inflation is low, but the jobs picture isn't so good, the economy isn't growing, then the Fed can lower interest rates and kind of boost the economy. It doesn't have to worry about rising prices and inflation because that's already low. So it can kind of boost this side of its mandate. So if the Fed is raising rates, then usually it's seeing a strong economy, it's seeing a strong jobs picture with low unemployment, but high inflation. Okay, so if the Fed's going to be increasing rates, probably means the economy is doing okay, which means stocks are going to be doing okay. And that's what a lot of investors, that's what a lot of pundits and people in the news media aren't really looking at right now when they're saying the sky is falling because the Fed is increasing interest rates. Okay, now what you should be worried about, and like we said, when the Fed stops raising interest rates, when the Fed pauses or slows down on its interest rate cycle, that's caution for alarm, okay? Because think about what that means. The Fed has looked at the data, looked at the economic data, and is saying, just a minute, we better stop raising interest rates. We better stop slowing down the economy because the economy is getting pretty slow right now, okay? Unemployment might be coming up a little bit. There might be layoffs because of the cost of borrowing and that slower economic growth. So they're going to slow down on their interest rates, or even pause or stop the interest rate hike cycle. That's when you need to be worried, because that's a sign that maybe either the Fed has gone too far in its interest rate hikes, or it's seeing something that other people aren't seeing. It's seeing a slower economic growth. It's seeing weakness in the jobs market, or some of these other factors that could eventually lead to a recession. So I don't think you really need to be worried too much right here, like a lot of investors are, climbing that wall of worry over the Fed rate hikes. I want to get into the rest of the live stream, and first though, I do want to invite you to get the weekly bow tie. It's our weekly newsletter. We put this out every Sunday night before the market opens. All the stock market news, strategies, and trends for the week. It's really what I like to do each week out for you out there in the community. Look at the markets, where they're heading, and some of the things I think you should be looking for. It's all completely free, just something I like to do each week. So I'm going to leave a link to that in the chat room. I'll pin it to the top of the chat here. I'll also put it in the description below. Check that out. Again, like I said, it's all completely free, and it's going to get you started for the next week on stocks, for each week. Now let's look at what the markets are doing today. I do want to let's move it over to Yahoo Finance to see where the markets are trading. It does look like markets are about flat. Looks like markets are going to open slightly negative for the week. Of course, we did have those 2 weeks of positive returns. All three market indexes rose last week, with tech stocks in the NASDAQ now up 12.9% over just 2 weeks. Okay, the NASDAQ is still off its highs by about 14%, but a hell of a lot better than it was, down 20% from the high. We actually did hit into a bear market there slightly. But the last 2 weeks have been really good, and I think the momentum is still there. Despite the very slight negative futures for this morning before the market opens, I think like we talked about, I think investors are still in that buy the news mentality. They're seeing that interest rates aren't going to kill the stock market. We've seen data and historical data proof that stocks don't typically fall during that rate hike cycle. And the economy is still good. Consumers are still healthy. They're still spending, and the momentum is positive until Friday. And we're going to talk about that. We're going to talk about what Friday's jobs report could mean, what the CPI, the Consumer Price Index that comes out on the 12th of March, what that could mean for the market, and kind of how to play this, because it could be a real turning point for the market. Of course, the confound to all of this is going to be crude oil. Oil jumped last week 7% to end at $112 a barrel. It is now down 5% to start this week at $107. So that's good that oil is coming down, because if we get any kind of unexpected news or an escalation in Ukraine and oil jumps again to 120, 130, that could be the point that drives stock prices lower on that fear of inflation and really consumer spending. Really, here we're at a point where if the consumer can stay strong, in the face of $4.50, $5 gasoline, then the economy will grow and the stock market will perform. If the consumer starts getting jitterish, though, if this consumer starts pulling back on their spending because of those high gasoline prices and other inflation, then that's when you start getting a problem. The U.S. economy is 70% consumer spending, right? So if consumers do get scared a little bit about inflation, that's where you got to worry. Gold was actually down 1.8% last week, and it's really something we've been talking about. Something we've been talking about over the last few months. Gold is now down right now to $19.39 an ounce. Really range bound. Even the threat of a global war, of an escalation into a world war, couldn't take gold above $2,000 an ounce on a sustained basis, right? So it is being held higher than about $1,900 an ounce. That's higher than the range it's been over the last couple of years. But, sky high, 40-year high inflation and a war, and yet gold cannot break out higher. So I really do think gold is expensive here. If you want to invest in those commodities, I would look to maybe some of the other commodities, but really the producers of these, the oil explorers, the gold miners, the agricultural producers of those grain commodities, because those are the ones where you're going to get that dividend while you wait, for the commodity prices to move higher. Bitcoin actually jumped last week, just under the 45,000 level that I thought it might get to. The week before, I had said it probably could get to 45,000 since this recent jump. It did make it to about 44,700 over the weekend. It's wow, it's now up 6% this morning, 47,000. Bitcoin up to 47,242. That is a strong breakout. And what we're really seeing is here with this risk on market, with stocks returning to favor, with investors returning to the market, you're really seeing a breakout by Bitcoin and the other cryptocurrencies. So we're going to talk about that and what to look for in that. I want to look at the sectors, how the sectors did last week, kind of what to look for in each sector of the economy, how those are trading, and kind of how to look at this as far as trends in the market. Of course, here we are at the Select Sector Spider. This is, all you out there in the nation know, this is one of my favorite resources for really getting that big picture macroeconomic idea on the market. So that's sectorspider.com right there. You can go to tools here in the menu. You'll go to a sector tracker, and that's going to show you the 11 sectors of the economy. You can do different time periods here. We'll come out to 5 days to see how it did last week. And again, you'll see the stocks in the S&P 500, the 500 largest companies in the United States, and then broken down into each sector, each of the 11 sectors right there. And what you'll see is energy was the standalone winner last week. 9 of the 11 stock sectors did close higher, which was extremely positive. Even on that surge in interest rates. Okay, interest rates jumped last week to 2.5%. From just 1.6% to start the year. So whereas last year when interest rates jumped from beginning 2021, interest rates started at about 1%, jumped to 1.7% by that February or March time, and that's what really started that death of growth stocks. Okay, those growth stocks, the Nasdaq sold off really hard at the beginning of last year when interest rates jumped. What we had this year is really kind of the opposite. Investors sold out of a lot of those growth stocks. The Nasdaq over the last couple of months were worried about higher interest rates. And then when the Fed did start increasing rates, when rates did start going up in the market, then it really hasn't had that effect. Investors are back into the market, buying this market and buying a lot of those stocks. Energy obviously doing well last week on that jump in oil prices. But what we see is that if we even go out to the year to date, then two other sectors, financials and utilities, are also in the green. After that huge sell-off in January and February, most of the sectors were down negative territory, but we do have financials and utilities joining energy now in positive territory for the year. And I think that's really telling. Okay, one, obviously utilities is going to be that safety sector. Okay, one of those sectors, the stocks in that sector, investors flee to that when there is time of risk off. When the rest of the market is falling, because those are fairly safe, stable companies. So utilities have done well. Financials, though, is really what I'm watching for this year. As interest rates go up, if the yield curve stays sloping, so that means if lower interest rates, if short-term interest rates are below long-term interest rates, you're going to have a lot more profit at the banks, right? The long-term interest rates, as they go up, that's what the banks lend on, right? They pay you that shit low rate on short-term interest rates, pretty much zero on your deposits, and then they loan your money out to long-term mortgages. They're now going up to about 5% on average, right? So the banks are making a lot of money. That's why financials are now in positive territory for the year. And I'm continue to watch financials for the rest of the year because I think the bank stocks and stocks in that sector can do really well. If you do want to look at kind of what kind of stocks are in each of these sectors, of course, you can always click on any sector here. That's going to show you the stocks in the S&P 500 within that sector. Okay, so we've got financials, we've got People's United Financial, you've got Allstate, which is insurance, you've got Berkshire Hathaway there, other banks, payment companies like American Express. So what you're going to find here in the financials, you're going to find the asset managers, you're going to find the banks and insurance companies. And I would really be watching those banks, especially the smaller community banks that do most of their business on those loans. So that is what I'm looking for there. What to watch this week? This is momentum is clearly positive and on investors' sides right now. So that's really giving me hope that we can stretch this rebound out at least another week or maybe even two. But that doesn't mean that data or some of those unforeseen events can't knock the market back lower. Okay, what I'm really looking at here is the consumer price index, which comes out on the 12th of March. That's the next big inflation scare that we could get. And then this Friday, the jobs report. So let's kind of talk about that. This week, we do get the personal consumptions expenditures report. That's the PCE, and that's just one of the three real measures of inflation that we get each month. Okay, first is the consumer price index. Usually comes out on the 12th of the month. Right, that's for consumer prices. We get then we get the producer price index, which is really inflation that producers are finding and paying, and then we get the PCE, which is that consumer or that personal consumptions expenditures survey that comes out towards the end of the month. That's what the Fed watches as far as its inflation measure. After, by the time it comes out, though, late in the month, it's really usually an after the fact kind of thing, right? Because we've already gotten those two other inflation measures, the PPI and the CPI earlier in the month. We pretty much know what the PCE is going to say as far as month over month and then year over year inflation. So it's really kind of a non-event, okay? The Fed does watch it, but it's something we pretty much already knows how it's going to stand out. And that's true this month as well. More importantly, though, this month is we know that a lot of inflation just hit over the last month. So this PCE report this month that shows February inflation, as well as the CPI that was reported earlier in the month that shows February inflation, that did not capture the inflation in these rising gasoline prices and other prices due to the Ukraine conflict, right? So what is really worrying is what we see next month. Okay, next month on April 12th, then we get the CPI, the Consumer Price Index for the month of March. Okay, what inflation did from February to March and then the year to March. That's going to show that rise in gasoline prices. And that's going to start showing, the rise over the next couple of months. That's going to start showing the rise in food prices, grains, things like that, due to the invasion of Ukraine. That's really where I think you could get that second inflation scare. Okay. Inflation is already up 8% year-over-year basis for consumers. I think it could go as high as 10% when the CPI is reported on the 12th of next month. Okay, that could really jolt the market back into that higher inflation. It's gonna cement a quarter or half basis point hike by the Fed. And so be watching for that. More, up closer though, this Friday is the March jobs report. Okay, again, first Friday of every month, the jobs picture is reported, the jobs created from the last month. So in April, the first Friday of April here, we'll get the March jobs report. How many jobs were created in the month of March? Economists are expecting 460,000. Again, just like we saw last month, I think that's very low. I think that is way low. We talked about this last month before the jobs report. I said it was too low. I said we were probably going to get a surprise, and we did by nearly 200,000 jobs. Okay, created more than 200,000 jobs, more than economists were expecting last month. We're really starting to see the jobs picture turn around, whereas over the last year, it's been very, very disappointing how many jobs have been created each month. Now we're starting to see the other side there. All those stimulus checks, the savings consumers had from the stimulus is running out. People are really being forced back to work, right? So we're seeing a lot better jobs improvement here, and I think this Friday is going to be another one. So really, the market did kind of come down a little bit last month when the jobs picture was reported, and that was higher than expected. Really, the idea here is this good news is actually bad news for stocks if the market is worried about those interest rates, right? Because a good jobs picture, higher jobs created means remember, lower unemployment means that the Fed doesn't have to worry about unemployment. The Fed can raise rates, not worry about the jobs picture, and try to kill that inflation. Okay, so that is just all but going to cement in another half point interest rate hike in the Fed's next meeting. The market could look at that, kind of get negative. So I do like the market for the next few days, but Friday, watch out. Friday could be a negative day because of that jobs picture if it is above expectations. Interest rates are really jumping. 10-year Treasury rate, like we talked about, up to 2.5% last week. So it's come up quite a bit. But again, it hasn't killed stocks in the past. What I want to look at now is some of the stocks I'm watching for this week. Just very few earnings going on this week, but some important ones. Let's refresh this one because I know Lululemon Athletica does report today. I want to see if the stock is trading or moving any on that. It's slightly positive this morning. Now, Lululemon is reporting earnings, actually reporting Tuesday. Expectations for $1.98 in earnings on $7.5 billion in sales. Now, it would be easy to say this one is sold off enough. Okay, so you see it's down from $477 at the peak last November. It's sold, down to $320 a share now. It would be easy to say that. Nike had some really good numbers, really strong earnings report when it reported. The Gap, the Athleta brand at the Gap has been one of its strongest growing segments to athletic wear. And we are seeing early signs that people are starting to get out and starting to exercise, joining their local gym and things like that. The problem is Lululemon still trades for 6.9 times on a price to sales basis. Okay, extremely expensive versus just 0.32 times for shares of Gap. Even Nike, which is still fairly expensive relative to those, 4.6 times on a price to sales basis. Okay, so Lululemon 6.9 times price to sales is pretty expensive. Now, granted, this company is growing sales by about 30% a year, but they're going to have to keep up with that. And what we've seen lately is a lot of these growth stocks, a lot of these expensive stocks that are based, the valuation is based on that growth rate. They are coming down hard on earnings when management guides negative or guides a little bit pessimistic on this year's earnings. Okay, so watch for that. Watch Lululemon, that's ticker LULU. When it reports on Tuesday, management is going to have to prove that it can keep those sales growing at 30% a year and that it deserves that higher valuation, that 6.9 times price to sales basis, if it wants to keep that. Or, if it says any kind of a warning for 2022 sales, that might not happen. It could be bad news for the stock. Okay. Dave & Buster's up 3% so far. Pre-market, market's just about ready to close. They are reporting earnings this week. Restaurants have continued to be hit even on the rebound over the last couple of weeks. And while sales have rebounded, they're up. So the company, Dave & Buster's Entertainment, ticker PLAY, it's up 3%. They probably had something good to say for the probably a good outlook, which is really what the market is looking for. Probably a good outlook for 2022 sales. Companies' operating profitability. That's really what you want to look for, though. I know they're probably on the call right now saying good things about the company, saying good things about consumers getting out to play in the restaurant through 2022. But if you look at their margin, I would look at what their margin is doing, their operating profitability. So that's their operating income, what's left over of sales after paying their cost of goods, after paying their suppliers, after paying all their wages and administrative costs, all that. That has fallen from 12.7% of sales in 2019 to just 8% over the last year. Okay, so that's a real warning sign, especially in the inflation that we're seeing, that their costs are going up so much, they're not able to raise their prices quite as much as they need to cover that inflation, and their profitability, their margin is going way down. So I would definitely watch that, compare that with some of these other restaurants. Shares are still relatively expensive. It's up, it's up pre-market today, but shares are still relatively expensive at 2 times on a price to sales basis versus something like a Cracker Barrel, which is 0.88 times sales. Brinker International is 0.48 times sales. So still more expensive than a lot of the competitors out there. Also looking at cannabis stocks. Cannabis stocks had a big day Friday. The ETFMG Alternative Harvest ETF, that's the main cannabis stocks ETF there, ticker MJ, is up 6% last Friday. Really on some acquisition news last week, as well as just positive investor sentiment, something we've been talking about last couple of weeks. I don't see any kind of real federal legalization happening this year, even since it is an election year. But we did get some rumors there. We did get some political positioning there, and that's what boosted these stocks. These marijuana companies, these cannabis stocks are down hard over the last year. We can see this. I did a video in September of 2020. did a September 2020 video on cannabis stocks. It was right around $10 a share. It jumped up to $24 last year, by February of last year, and then has just since crashed back down to about that $10 level. So I think this is another point where you start getting interested in cannabis stocks, and you see this all the time with this group, right? You see this all the time with cannabis, with marijuana companies. They go through these cycles of hype and investor sentiment where, if you can time it right, if you can find those cycles where investor sentiment is so low, like it is now, $10 a share on this alternative harvest ETF, you buy in now, you wait for investors in the market to get so excited about these stocks again, and then and you take advantage of that ride, of that cycle, because it does happen pretty frequently there, for those stocks. In cryptocurrency, it was kind of weird last week that no news was really good news for cryptocurrency last week. We didn't have a lot of market moving news. We did get Russia saying that it could accept Bitcoin for its oil purchases or for its oil exports. We got the SEC continued to drag its feet on any kind of a Bitcoin ETF as far as a non-futures based, so a spot traded ETF. But again, ironically, the fact that there was news, was no real big news for Bitcoin or cryptocurrencies, really boosted the stock price, and that's supportive. I think that means that as long as there's no real bad news for cryptocurrency, as long as the markets are flat or even going higher, then you're going to get that positive support for Bitcoin, for cryptocurrencies. Like we looked about in the market today, up to 47,000 per Bitcoin. Some of the other cryptocurrency prices, Ether is also up. So you're seeing some real institutional buying in these cryptocurrencies. We saw last week also Goldman Sachs was actually the first to start trading Bitcoin options, which is big for the market. It's a big sign of institutional buy-in and liquidity for the market, which is something that Bitcoin and cryptocurrencies, they really need that liquidity. They need those big institutional money managers to start playing in it, start trading and that kind of thing, to give the confidence to other institutional managers to buy in and to invest. So we did see that last week. And it's really supportive. So again, no news or good news going to be good for cryptocurrency. Bad news going to be bad. If the stock market falls, going to be bad for cryptocurrencies. But like we've seen, stock market generally does well during Fed rate hikes, and I think that's going to be supportive of cryptocurrency as well. Some other things I've been looking at over the past week. We got a news article here. Wall Street bets on gym chains getting back in shape. So a lot of private money and investor money going into these gym stocks, into these gym chains. People are actually starting to get out of their house and for 2 years kind of let their waistline go, and now they're kind of worried that their asses are getting out of shape. So a lot of people getting back into the gym. And what I think you look at here, some of the gym stocks are probably a little bit more expensive over the last couple of weeks. They've rebounded, but what you can do is look at related plays. Look at things like Weight Watchers International, which is ticker WW. Look at other health and nutrition companies trading on the market. I think those are the next to follow on this trend. If people are starting to get out of their house and are starting to worry about their weight and their health and starting to exercise again, then that's going to be a trend that's going to unfold over the rest of the year. So that's something to watch there. I do want to cover one more idea, then we'll get into the question and answer. Always my favorite part of the live stream, answering your questions and really kind of back and forth with you out there in the community. We've been talking a lot about the rally in stocks of Chinese companies over the last couple of weeks. Alibaba is now up 47% since the video we published about 2 weeks ago. Obviously, a lot of the regulators have come out in China and said, okay, we're going to slow down the crackdown on regulators. We're going to be supportive of IPOs overseas and things like that. So Chinese stocks have rebounded. They did sell off late last week though on those delisting fears. Okay, so if you don't know, a lot of Chinese stocks traded in the United States are at risk of being delisted in the United States if they don't make their auditors compliant with U.S. rules. Okay, and we won't go into that. We went over that in the video we did a couple of weeks ago on Alibaba. So there is still that risk that they get delisted. The thing you can do though, what can protect you? You can get the upside to Chinese stocks because a lot of these stocks are still in value territory. I own shares of Alibaba. I own shares of DD Global. Both those stocks I added just before they started rising over the last 2 weeks. My cost basis in Alibaba is about $87 a share. Cost basis in DD is about $1.70 because I sold some covered calls on those. Which in fact, DD is now up about 100% from where I bought it at that point. So there is some strong upside left in a lot of these Chinese stocks, but the problem is you still have those delisting fears. The SEC is going to continue to come out with these warnings that such and such company has filed their annual report. It wasn't compliant with a U.S. auditing procedures, and they are at risk, as soon as 2024 of delisting, right? So you're still going to have that downside risk to delisting. What you can do, a really cool trick here to invest in these without that delisting risk is some of these exchange traded funds. Now I've got up here the Crane Shares CSI China Internet ETF. That's ticker KWEB. Now what's interesting here is Crane Shares came out last week and announced that they were going to be transitioning all their China ETFs. So these exchange traded funds traded in the US, they're going to be transitioning the stocks that they hold in those funds to exclusively the Hong Kong listed stocks, right? So a lot of these companies, Alibaba, you've got Pinduo, you've got a lot of these Chinese stocks, they have dual listings, okay? They are traded as a stock on the Hong Kong exchange as well as in the US. Now, what happens if they get delisted from the US? They're still going to be traded on the Hong Kong exchange. The stock is going to be the same. It's going to be the same company. You just won't have access to it in the US exchange. So what a lot of these ETFs are doing, they're transitioning. Instead of buying the ADR shares, instead of buying the US listed stocks, they're buying the Hong Kong listed stocks. Same company, same stock. It's just without that delisting risk. So that means that, these funds of the Crane Shares China Internet ones would not be exposed to that delisting risk. So you're going to have the upside without that delisting risk that you might have if you're holding those same stocks but traded in the U.S. exchange. You can get the Alibaba, the JD.com, and the Baidu without that risk that the ADRs, the U.S. listed stocks, are going to stop trading. Now you have to watch out here though, because some of these other ETFs might not have that same opportunity. You've got ETFs like this Golden Dragon China, the Invesco Golden Dragon China ETF, that's ticker PGJ. They haven't made that announcement that they're transitioning to Hong Kong stocks. 97% of the assets in this fund are those U.S. listed stocks, are the China stocks traded on the U.S. exchanges, those that could be delisted. And in fact, there's about 21%, about 1 in 5 of the stocks listed in this fund do not have a dual listing, do not have a Hong Kong equivalent stock. So they wouldn't be able to move all of their assets into that Hong Kong listed stocks. So you really do have to be careful here, but there is an opportunity to continue to get those that upside to the Chinese stocks without getting the delisting risks. I do want to turn it over into the Q&A here. Favorite part of the live stream, just seeing what you guys out there are talking about. Any questions? I'm going to scroll up to see what questions we have here. See a lot of you out there in the Bowtie Nation. Thanks for joining us. Thanks for showing up here this morning. What else? Okay, Ethan says, thanks for the tip on PBT Royalty Trust. Appreciate that. Says dividend stock prices are ramping, and they are. For last couple of months, one of the things we've been talking about here is, those oil prices. And even before the invasion of Ukraine, even before oil prices just went crazy, oil prices were strong. And what I was watching here over the last couple of months is that, with higher oil prices, usually you get those explorers, you get the oil companies just ramping up their production, just drill, baby, drill, right? And producing as much as they can to take advantage of those oil prices. But what we've seen over the past few months is that the oil producers are having a lot more discipline, in than they've had in the past. They're not ramping up their production, so that's not only supporting oil prices higher, but it just means they are cash flow machines, right? The cash flow is just booming into these oil companies. They're not spending it on the exploring for new wells and capital expenditures and maintenance and that kind of thing. So they're raising their dividends, they're raising their stock buyback programs, and really pushing more money, more cash flow out to investors. So that's one thing we were watching over the last couple of months. A lot of these oil companies, they are up. The oil companies in the S&P 500 up 44% already for this year. So a little expensive at this point. I still think they can be good dividend plays, good dividend stocks, but you do have to worry about valuation at this point. But that was good there. Have you been following past years? Okay. Rick out from New Mexico. Good to see you there, Rick. What do you think of? So Sammy wants to know, what do I think about AT&T? Okay, AT&T actually had its investor day on Friday. Kind of outlined the plans for that split of the Discovery assets. And actually, if you've been watching the channel, following the channel, I have talked about AT&T over the past couple of months. I did buy a position here for the first time in I think it was January, right? My position, and we can look here. We can look at what AT&T is doing. I haven't been a fan. I haven't been a fan in the past of AT&T. It is down just slightly today. My cost basis is right around $22 a share. I bought it over the last couple of months. In the past, I really haven't liked their strategy. Management has dropped the ball big time on that acquisition strategy over the last couple of years. They've been buying like crazy, right? They really had that acquisition growth strategy that you have to watch out for in companies. It gets a lot of companies in trouble. They were buying, they bought Time Warner, they bought Discovery, or they bought Time Warner, they bought DirecTV, then they paid tens of billions of dollars for those companies, hoping that it would increase sales beyond their slow, stable telecom revenue sales. And of course those acquisitions rarely work out like they say they will. It just loaded the company down with hundreds of billions of dollars in debt that it just couldn't sustain. It couldn't sustain the debt. It couldn't sustain the dividend payment on that, or the dividend yield on that kind of debt. And so I was really negative back as far as 2019. I did a couple of videos on the danger in that stock, in AT&T. You can see it's gone down ever since. That video was right around September of 2019. It was up around $36 when I did that video. Big sell-off there during the pandemic of March 2020. It never really recovered and has kept falling. Now I see the turnaround strategy. AT&T down about $23 a share. Dividend yield is about 8% right now. It's going to be cut after they make that split off of the assets, of the Time Warner assets to Discovery. But they are on the right track, and this is why I bought the shares, because they're now strictly a telecom company doing what they do best, doing what they've always done best, just providing that wireless service and those telecom services. It's a cash flow business. The stock is very cheap here, and they've been investing heavily in their 5G rollout over the last couple of years. So this is something that investors aren't really seeing right now, is that, yes, earnings are low for AT&T, for a lot of these telecom carriers, because they've had to spend those tens of billions of dollars for that 5G build out over the last couple of years. Well, now what happens? Now they don't have, over the next couple of years, they're going to start collecting those higher sales on the 5G, but they won't have the build out costs. They won't have the huge costs that were incurred to build out that network. So they're going to have the revenues, not quite the costs. That's going to improve cash flow. They're also, AT&T, again, also downsizing. They're going to get a huge cash paycheck for spinning off the Time Warner assets to Discovery. That's going to protect the dividend right around 4.5% to 5%. They've said it's going to cut down to about $1.11 per share when that dividend is cut, but it's going to be stable. It's going to be increasing over time. And I really like this one for not just that dividend yield, 4.5%, 5%, after the spinoff, but it's a good value stock. I think this one could go back up to $30 a share easily, plus that dividend over the next couple of years. So definitely one I would watch, and if you want just that stable, safe dividend paycheck, then AT&T would be one to watch. Got to get my go juice. Okay, what else? What else are we looking at here? 2% target inflation. Monday morning. So Nemo says, best part of Monday morning. Thank you for your time and work. I appreciate it, Nemo. This is as much for me as it is for you, right? I love doing these live streams, just kind of a closer face-to-face connection with all you out there in the nation, closer than we usually get with the regular videos. Gold prices are manipulated. What else? Trying to see if you've got a question, make sure you use a question mark so I can see that it is it is a question. Okay, Paul Pollock wants to know, where would you invest $50,000 right now? I want to take some money out of the bank. Okay, so if we got $50,000, actually, I do have a video coming up this Friday. The 7 stocks that my highest conviction stocks right now. Okay. And in fact, I've got $250,000 in these 7 stocks. Okay, these are the 7 stocks that the largest stocks in my portfolio. Make sure you check that out on Friday. So if you're not, click that subscribe button and the bell notification so you make sure you see that when that comes out. $50,000. Now that's a tough question because I need to know what else is in your portfolio, where you're standing right now to know that you're not just putting it all in one stock or all in 2 stocks. If you're just starting out, you don't have any stocks or anything in a portfolio, you want to start off with that core satellite strategy, right? You want to start off with maybe 3 to 5 ETFs, exchange traded funds that really cover the market. You do about 50-60% of your money in that to really give you just that broad base and those market returns. After that, then you can take the rest of your money, that 40% of your money, and invest it in 8 to 15 individual stocks, right? You really want to be selective, and you can be. If you've only got 35 or 40% of your money in individual stocks, you can be selective. Buy 10 to 15 of those individual stocks that you really like and you're really looking at. Some things, some individual stocks that I am looking at, things that we're going to talk about here on Friday with that video. You've got stocks like like Groupon. And I know a lot of you out there, you're laughing right now. I say Groupon, but hey, this is the single most mispriced stock in the stock market today, right? Groupon shares, ticker GRPN. And you're going to see that in that video. I just run down exactly why this is mispriced. Folks, the cash that Groupon has on its balance sheet, plus an investment it has in a startup company, a UK startup company called SumUp. It's a payment processing company valued at $20 billion in its last funding round. Okay, so they just went through a funding round, valued the company at about $20 billion. Groupon owns 2.4% of that. Okay. Now, even conservatively, even if they can only monetize maybe $17.5 billion of that investment in SumUp, okay, so say SumUp gets acquired, say it goes IPO, and Groupon monetizes that investment that they have in that company, that 2.4% stake in that company. Even if it's valued at $17.5 billion, that is $420 million for Groupon. Okay, in addition to the cash, in addition to about the $300 million net cash Groupon has on its balance sheet. That's $700 million, just in cash that Groupon has. Look at what the market cap is right now for shares of Groupon. Okay, it's down. I think it's down to about $550 million. Okay, so this company that produces $1 billion in sales every year is valued at less than the cash it holds and an investment it has in another company. That is terrifically mispriced. I think shares of Groupon could be up to $30 a share at least. Let's see what it's happening. What it's doing in the market. It's GRPN. What is Groupon doing today? It's probably just to prove me wrong, it's probably down hard. Nope. Up slightly today, up to $19 a share. Again, folks, I think this is a $30 stock at least, maybe even up higher to $40 or $50. You can see it did pop in January up to $30 a share. It was up last year past $40 a share, but now down at $19. And again, I think this is just a mispriced stock. I think the market isn't valuing that cash and the SumUp investment correctly. So I think that's one of the stocks I would really be watching. Some of the other things I'm watching: SoFi Technologies, SOFI, PayPal, Teladoc is another growth stock that I'm watching. Folks, a lot of these growth stocks that have sold off so hard over the last year. Now is the time to buy. Okay, if you were following the channel last year, I hated these growth stocks. I hated the valuations on those growth stocks like Zoom, like Teladoc, like SoFi Technologies that came out through a SPAC merger, right? These stocks were just trading at crazy, ridiculous, insane levels of 30 and 40 times on a price to sales basis. And I wouldn't touch them. I said that last year. And look at what's happened. They've come down. Teladoc is now trading for something like 5.5 times on a price to sales basis. It's down to like 70% or something from where it was last year, but it's still the same company. Okay, this is still the future of healthcare, virtual healthcare. It's got a lock on the leadership in that space, and it's still, management saying it's going to grow to about $4 billion in sales through 2024. Okay, so if you look at these companies now, a lot of these growth stocks, they're trading at just a very good valuation levels. They're still very strong growth stocks. Now is the time you want to start looking at these, and now when everyone else is sold out of the stock. Okay, how affects REITs. So Rob Canton wants to know, how will the higher interest rates affect REITs, real estate investment trusts? And that's a great question. One, because we do know that, okay, so higher interest rates tend to it's a cost. It's if you're going to borrow money to buy real estate, to buy commercial real estate or residential, that's a higher cost. So it does tend to weigh on real estate, real estate companies, real estate properties. The other side of that, though, is that, like we talked about earlier, if we look at how the asset classes did, and we can actually look at, how they did over those 3 rate hike cycles. So again, this data, all 3 rate hike cycles in the past, 99 to 2000, 2004 to 2006, and then 2015 to 2019, interest rates were increasing. And real estate investment trust, real estate properties. So that first one, the 99 to 2000, real estate stocks did start coming down. They posted a negative 0.6% annualized return over that period, over that 1 year period. But then in these other 2 periods, they were positive returns. Real estate stocks still increased 24% annualized in the 2004 to 2006 period, and then up 8.5% a year in 2015 through 2019 when the Fed was raising rates. Now, obviously, we know what happened afterwards, though. We know what happened after July 2006 when the Fed stopped raising rates. You didn't get this 24% return on real estate. Okay, obviously, the sell-off was pretty bad when that real estate bubble crashed or popped. So what you got to understand here is a couple of things about real estate. It can do well while the Fed is raising rates. Okay, it can keep rising because the economy is doing well. Okay, jobs, the jobs picture is good, consumer spending is good. So real estate investment trusts can do well. The problem with real estate investment trusts, the problem with these real estate stocks is you got to look at it on a property level, on a property type level. Okay, because not all real estate stocks are going to do well. Okay, you've got things like office. I actually saw a Wall Street Journal report over the weekend that vacancy in New York and Midtown Manhattan and downtown is still extremely low in New York because people just aren't returning to the office. Okay, people have just found out how they like that work from home kind of atmosphere, and they're sticking with that. Okay, so office occupancy is still extremely low in New York and in a lot of these cities. So office could be hurt. Self-storage. We've seen self-storage properties go ballistic over the last couple of years. Some of these self-storage stocks in the REIT space are up 60, 70% over the last couple of years, which is, kind of insane. The valuations are getting very expensive, and those have actually started to come down, okay, because on that valuation. Some of the other property types looking a little bit better though, and I think you still need to watch those. The industrials, so all those warehouses that are storing those the e-commerce purchases and the stuff getting shipped out, those are still doing really well. Hotels and motels and the leisure properties, those are still doing well. As the consumer finally gets out, finally starts traveling like they couldn't do over the last couple of years. So with real estate stocks, you really need to look at it on a property level and and be watching for that and be investing in that. I do want to share how to do that here, how to kind of look at those property level returns. If we go here, if you type in so REIT, so REIT returns by property type, and you can see it pops up on the drop down because I look for it all the time on Google here. So REIT returns by property type, and what you're going to find here is this usually the first thing that comes up in your Google search. It's going to be performance by property sector by NAREIT. Now, this is the National Association of REITs. This is the main organization that tracks those. So on REIT.com. And what you can do is you can see here monthly summary performance as of February 28th, 2022 for these. We'll just open up the PDF version here. And we're going to download it so it's a little bit easier to see on the screen. Okay, what you've got here, the investment for performance by property sector and subsector. And these are all the REITs. Okay, so you see the year to date, 2022, you see February, you see 2021. Okay, so what they did last year. And these are the NAREIT all equity REITs. So that's all your equity REITs, the REITs, the real estate investment trusts that own property, down 11.5% so far this year, up 41% last. Big sell-off in the industrial properties, like I talked about, 62% up last year, down 14% this year. But that sector is still, or that property type is still doing well, and I think can continue to do well. You know, these have obviously come down off of a little bit higher valuations, but all that all that e-commerce, all that shipping and delivery stuff, it has to be stored somewhere. Okay, so that is being stored in warehouses, industrial properties. Those are doing really well. Office was up 22% last year on hopes for a return back to the workplace, down 2.7% this year. So not quite as bad of a sell-off, but again, it didn't go up that much last year either. But if you look at some of these, residential properties, so your apartment REITs, up 63% last year, down 7% so far this year. I would worry about residential. Rents are getting extremely expensive. Interest rates are going up. So you kind of got to worry about what interest rates are doing to residential properties. You've got lodging and resorts. This is what we were talking about with hotels, hotel REITs, hotel stocks, up 18% last year, so not a huge rebound, and still up 1.5% this year. So one of the few property types that are actually still up in positive territory so far this year. I would keep looking at that. I would keep looking at these hotel and leisure property resorts REITs, because those I think can continue to do well as long as the consumer and their consumer spending doesn't completely fall apart. Okay, those obviously people, they've been locked down for 2 years. Travel is on pretty much the top of everyone's list of things to do now after the pandemic. People are getting out, people are taking flights, and they're going to those resorts and using hotels, staying in hotels. So I would definitely be looking at those travel and leisure, those hotels and resort stocks. Healthcare, I like healthcare as well. It is down 5.8% so far this year, but this is another one that was hit by the pandemic. But a lot of those healthcare facilities, a lot of the senior living facilities are now on the rebound. They're doing better. They've obviously got those great demographic trends in their favor. As people get older, they're going to use more healthcare services. So I think these are a lot of good stable idea over the next few years. Self-storage, like we talked about, up 80% last year alone. Okay, self-storage REITs, you've got things like PSA, Public Storage. You've got a couple other storage companies in the space there, up 80% last year. That is just insane. Okay, property prices are usually fairly consistent, kind of a slow and steady growth. You don't get 80% return on a property sector in a single year without some kind of a give back. Okay, without valuations getting to insane levels, and we're going to see that here this year. I think you're going to see self-storage have problems all year this year. It's down 11% so far this year, and I think you continue to see that fall. Data centers are actually getting a little bit cheaper here. They were up 25% last year. Very strong returns over the last couple of years. Obviously, as data and data traffic increased through the pandemic, you saw those data center stocks, those data center REITs really take off, up 25% last year, but down 17.5% so far this year. So these stocks, the companies in those data center REITs, are actually coming down into better valuation territory. I would keep looking at that because, obviously we're not getting off the internet anytime soon. So those would be one to watch to be a little bit better here over the next year. Okay, what else do we have here? No Tesla share offer. The inverted yield curve coming looks flat already. Rob says, the inverted yield curve coming looks flat already. Okay, so what he's talking about here is the yield curve of interest rates. Okay, so we have interest rates for all different maturities. Okay, for 3-month, 2-month, 2 years, interest rates traded over for 2-year bonds, 3-month bonds, all the way up to 15 years of the 30-year bond. The 10-year treasury, things like that. So what you get is kind of a curve. Okay, usually you see interest rates higher over the long term. Okay, because if investors are going to lock down their money in a 30-year bond for 30 years, they want a higher interest rate than something that they only have to hold for maybe 2 months or 2 years. Okay, so in a regular, growing economy, when things are looking good, interest rates tend to curve up like that. Okay, now what he's talking about, the inverted yield curve, is when short-term rates are actually above long-term rates. That's a warning sign of a recession. The old adage or the old rule is that when that inverts, then it's a sign of a recession coming up. If you do look at futures trading for interest rates, the futures market investors do think maybe the yield curve will invert sometime in maybe June or July of this year. That's going to be a negative signal for the market. But it's not 100% sure, right? It's not only do we not know if the yield curve will invert, we don't know if that's actually going to preview a recession either. Okay. It's just a fact of, the Fed raising short-term interest rates, a little bit sluggish economy, so holding down those long-term rates. But right now, the yield curve is still looking very good. It's still very positive and upward sloping. So I wouldn't necessarily worry about it too much. I think it's just one of the things that investors always worry about, especially during Fed rate hikes, is an inverted yield curve. You can't be too early on these things, though. Being with a lot of these predictions and looking at the big picture and the trends, being early is just as bad as being wrong. Okay, because being early, you're going to miss out on a lot of the upside, a lot of the positive returns to stocks. And of course, just as soon as you change your view, you change your opinion, and you get positive, that's when it's time to worry, and that's when stocks do start coming down. So I wouldn't worry too much about the inverted yield curve or whether it's going to invert or even cause anything further down the road just yet. As we looked at with that data, stocks still do very well during rate hike cycles, and I think they can continue to do well as long as as long as we don't get too high, too bad, shockingly bad of a CPI report on the 12th of next month. Okay, Kludge wants to know, can you talk about Alibaba, please? I talked about Alibaba earlier. I had that video on Alibaba 2 weeks ago. Check out that video, please, because, like I said, I do have shares of the stock. I own the stock because of exactly what I talk about in that video and what we talked about earlier in the live stream. Okay, shorting them since whatever. Okay, do you think synthetic biology will hit the cannabis stocks? Okay, Gary wants to know about synthetic biology. Yeah, I have no freaking idea. I haven't really looked at it. I don't have a degree in biology or pharmaceuticals or anything like that. So I couldn't tell you about synthetic biology. I think I don't think it's going to hurt cannabis stocks. I think you're always going to have a demand there and a market there, and I think cannabis stocks have just sold off too much over the past year. I think they are good valuation territory right now. What else? Oh my goodness. The scammers are hitting live streams all as well. Okay, so we've got a WhatsApp number here for you to call for big returns, and it's even got my picture in it, right? Folks, you got to understand, if you're reading the comments, if you're in the chat here, and if you're reading the comments to the videos and you see a comment with my picture, right? It's coming from me, and it's telling you they've got a great investment deal for you. They've got great investment news for you if you just call this number or text this number. Come on, folks. Really? I'm not going to text you. I'm not going to send you my WhatsApp number, okay? I love you. I love all you out there in the Bowtie Nation, but I'm not sending you my WhatsApp number, okay? That is not me. Do not fall for these stupid scams, these spammers that just spam the comment section with their WhatsApp number and say they've got some kind of great deal for you. It's usually they're going to send you 5 Bitcoin if you just send them half a Bitcoin right now. Okay, so that's a warning sign, right? Anytime somebody tells you they're going to send you a lot of money, if you just give them a little bit of money first, you got to give it to them first to confirm your account, right? No, bullshit. Okay, don't fall for these scammers. These are the lowest form of life on earth. They do nothing with their lives, and they just want to rob you of your money. So be careful for that out there. Okay, what do you think about Planet 13? Billy Marion, Devil Dog brother. What do you think about Planet 13? Haven't looked at it in a while. I gotta be clear, honest with you. I'm not gonna do like a quick 5-second opinion on a stock that I haven't looked at in a while. Obviously, it's in that cannabis play. It's in those cannabis stocks and marijuana stocks theme, and I am positive on that theme. So I think, one of the things all you out there in the nation know, one of the big things I like to invest in is those trends and the macro and the big picture. Okay, so I'll start with that big picture idea. Okay, where is the market, where is the economy going, and then I use that to drill down into the stocks. Okay, and what this does is, so if I'm seeing investor sentiment come back into cannabis stocks, if I'm seeing the legalization and the regulatory environment improve for cannabis stocks, I know that's going to boost all the stocks in that theme. Okay, it doesn't matter if you're the best player or the worst player in that theme, in that group of cannabis stocks. You're going to be lifted. You're going to be supported by that bigger picture idea. Okay, so what you get here is investor money coming into the cannabis stocks, some kind of progress and movement, or at least rumors on the regulatory environment. That's going to boost all of these cannabis stocks, including Planet 13. So, whether it's a great company or not, I think it's going to do well. It's going to be supported. What you need to do, obviously, then is once you've got your list narrowed down to just this theme that you think is going to be supported from these bigger picture ideas and these trends, then you look for the best of breed. Then you look for the best companies in those themes to try to get really the best of the best in that group. What else? Comments, thoughts on IVA. Where can I learn more about So Tim, great question. I'm glad you asked that. Where can I learn more about the core satellite strategy? Okay. I mean, a lot of you in the nation, I've talked about this a lot because it is my favorite way to invest. And really, I think, it's gonna decrease your risk, gonna decrease your stress level in your investing. And it's going to do a lot of things for you. So I want to show you where to find videos for that. I want to talk you through it a little bit. If you ever want to find any video or any theme that we've talked about, you go here to the channel, you go to videos up here in the menu. You go to videos and then you just search. You use this little magnifying glass, you search for it. So if we search for core satellite, and you're gonna find videos that cover that. Okay, videos where I've talked about that core satellite strategy. Okay, so one of those, top 10 ETF every investor owns. I guarantee you, I talk about the core satellite strategy in there. How to start investing in 2022. That's one of the ones we did over the last year here. I've talked about it in there. So anytime you want to find a video or something we've talked about on the channel, look in there. Now the core satellite strategy. Great strategy. Basically, again, what you're doing here is you're taking maybe half or 60% of your money. So this is all your investable assets. You're dividing it into two parts, a core part and a satellite part. Okay, the core part, that 50-60%, is just ETFs, just basic, some of the best 3 to 5 ETFs you like, right? So you're going to have an ETF that covers dividend stocks, maybe one that covers growth stocks, maybe one of these growth ETFs like the ARK or something not the ARK that doesn't lose all your money, but one of these growth stock ETFs that can really provide those upside returns over the long term. You're gonna have maybe a bond ETF, and I know a lot of investors, they see a 3, 4, 5% annual return on bond ETFs, and they say, bullshit, I'm not wasting my money on that. Well, look at what bond ETFs do when the stock market crashes. Okay, it is going to protect your money. It is not a big part of your portfolio, but it is a critical part of your portfolio to protect your money when stocks crash, and then you can take part of that bond portfolio and you can take advantage of those lower prices. So do not neglect bond ETFs here. Real estate ETFs, some of those REITs or something like that. You put those in a 3 to 5 of those ETFs, maybe even more, maybe 6 or 7 ETFs, exchange traded funds that cover a lot of assets, cover hundreds, thousands of stocks. You buy that with about 60% of your money. Okay. What that's going to do, it's going to give you those market returns. It's going to give you safe, stable returns over the long term. Whatever stocks do, that ETF is going to do. Whatever bonds do, that ETF is going to do. You don't even have to worry about it. Sometimes I go months without even checking my ETFs because I know it's going to be those market returns, those safe, stable returns in that asset class or in that part of the market. I don't even have to worry about it, right? No single stock in that ETF is going to destroy that fund or my portfolio. So that's 50, 60% of your money right there. Now with that rest of your money, that 30 or 40% of your money, then that's where you invest in those individual stocks. Now, a couple things here, because that's only a very small portion of your money, it's less than half of the money you have to invest in the stock market, then you're going to be selective. Okay. You don't have to come to YouTube and watch some Yahoo on a bow tie every single day looking for stock picks. Okay. You only need 8 to maybe 15 stocks that you really like, that you really feel good about. You like the company, you like the product, you think they have a competitive advantage, and you want to invest in that. Okay. So you are much more limited on what stocks you're going to buy. You buy 8 to 15 stocks. You use that part of your portfolio. Because you're limited, then you don't spend hours every week. You got limited time. You buy those stocks and you just keep on adding to them. So it's a much less stress. Okay, you don't have to worry about any one of those stocks destroying your portfolio either, because if you've got 10 stocks and 30% of your portfolio in those 10 stocks, that's only 3% of your money in each stock. Okay, you don't have 20. So I see some of these people, you get 20 or 30% in Tesla. Okay, and hey, Tesla's a great company. They're changing the world. But what happens when Tesla falls 20%? What happens when Tesla falls 30 or 40% or whatever it may do? If you've got 20 or 30% or half of your portfolio in one stock, if that stock crashes, who knows what happens? Anything can happen to good things or bad things happen to good companies. Okay, if you've got half of your portfolio in one stock and that stock crashes, you're done. You're toast. That is hard to recover from. If you've got 50% of your money in one stock, that stock falls, to zero. You've just lost half your portfolio. Even if it falls by half, you've just lost 25% of your portfolio. How do you come back from that? How do you not just get so disappointed, so frustrated with the market that you just cash out and quit? Okay, that's what we're talking about here with this core satellite strategy. You've only got about 3 to 5% of your money in each individual stock. And so it doesn't matter if somebody is reported to be scamming the company, using corporate funds to go to a strip club or whatever, and that company falls apart. You don't have to worry about that. Okay. If you've only got 3 or 5% of your money in that company, you don't have to worry about any single company just destroying your portfolio. So that's really part of the beauty of this core satellite strategy. Okay. So you've got those 8 to 15 individual stocks. You really like them. You don't have to spend hours looking for new stocks to buy. You've already got the ones you like. You don't have to worry about any single stock destroying your portfolio, but you do get the upside return. Okay. I know a lot of people out there, they just like investing in those ETFs, in those exchange traded funds exclusively, all their money in those. It's a stress-free portfolio. They don't have to worry about it, but they're only going to get the market return. If you're only investing in the Vanguard Total Stock Market Index, the VTI, you're only going to get the return on the total stock market. You're never going to get any better than that. Okay. So this way, with the core satellite strategy, you get those safe, stable market returns, plus you get the upside potential on picking great stocks. Okay. You got 8 to 15, even as high as 20 individual companies that you really like. If you pick good stocks there, you can make another 3 or 4 or 5% on top of the market returns. Okay. So that's really the beauty of the core satellite strategy. That's why I use it. That's why I recommend everybody uses it, to really, really lower your stress in investing and really, do things from there. Okay, what else do we have? Wait, stuck in advice. I came from the fashion. Yes. Yeah. Flip of the shipper. See all the YouTubers putting half of their money in Tesla, and this is what I hated over the last couple of years, that everybody was an investing expert because they invested in, what was going up. That was the entire strategy over the last couple of years. Invest in what's going up. And, so you had shares of Zoom, you had shares of, all the SPAC companies. Okay. GameStop, all you had to do was tell people to invest in those. You were a genius because those stocks kept on going up, whether you were doing any analysis at all. You could have 100% of your money in that one stock. It kept going up, and you were an investing god, a guru, right? And we see what's happened to that. So please, folks, learn how to invest for real. What really investing is really about, and don't just invest in something just because it's going up. Okay, always use these strategies here. Brandon wants to know about any insight on buying Amazon or Google before or after the split. Should we stay away from those altogether? Covered these on a couple of live streams now. Everybody's wondering whether they should buy ahead of the split. Buy both. Buy ahead of the split, buy after the split. Keep on buying. These are strong companies. Okay, Amazon and Google both. Amazon is actually in very good value territory right now. It is cheaper than it's ever been on a price to sales basis. Other than some of the big sell-offs, some of the crashes and things. So Amazon, very attractive. I actually looked through some analysis last week that says Amazon could be worth 60% more just if it split off its cloud services side as well as its e-commerce side. Just valuing those two separately rather than together could be 65% more expensive than it is right now. So, I generally don't care if a company splits, if a stock splits or anything like that. It does nothing for the stock. It does nothing for the company. It doesn't change it at all. You do get maybe some investors that can't buy fractional shares investing then after the split. But, it's really a non-event for most companies. Okay. Buy a company because it's a good company, not because they're manipulating the stock price with a split or a reverse split or anything like that. Okay, both of these companies, though, again, Amazon and Google, they control the world, man. You invest in what works and what's out there. Okay. Okay. Can you? What do you take on Golden Nugget? Can't tell you anything about Golden Nugget. Haven't followed it. Haven't looked at it in quite a while. If it's the Golden Nugget casinos, I don't know. Casino stocks, they've been hit over the past year. They haven't done well. Obviously, if you're looking at that big picture, though, if you're looking at the travel and leisure theme and the stocks coming back, people traveling, people doing that, then a casino stock could do well. I would be worried something, but for the Golden Nugget, if it is a casino stock, but it doesn't have that digital experience, then I'd be worried that they're maybe going to lose some of the business to that. Okay. You get a lot of these online casinos, the digital gambling and mobile gambling is going to take a lot of the market share away from those pure casino stocks, I think. So, there might be some upside there on just a rebound, on a rally in those casino stocks, but I would really want to invest in the ones that have the digital experience as well. Okay, any thoughts on Harris? Harris wants to know about Bitcoin. Talked about Bitcoin earlier. Obviously, all you out there in the nation have followed the newsletter and everything. I'm a big Bitcoin believer, big cryptocurrency believer. Over the last year, I started in 2017. I did not like cryptocurrency. I told people you'd regret investing in cryptocurrency because I didn't know. I didn't take the time, like so many people. I didn't take the time to actually research cryptocurrency, the blockchain technology, things like that. I've since taken the time, and there is some real value. There's intrinsic value in Bitcoin, in Ethereum, in some of these altcoins. I'm not saying go out and buy some of the shit coins. They're actually called poo coins. Those altcoins that have no real legitimate meaning or value. I'm not saying you go out and try to trade those and try to make $1 million in those. I'm saying buy the largest coins, the legitimate coins that actually do something, that work on the blockchain technology. You've got Bitcoin, you've got Ethereum, you've got Polygon Matic, which is doing some huge things with Web3 and a lot of those. You've got a lot of these coins that have a real intrinsic value. We've seen Bitcoin just take off over the last couple of weeks. Last I checked in the market, it was up to 47,000. It's testing out that $50,000 level. I think it's really getting a lot of institutional support. And this year could be really big. If stocks don't completely fall apart, then you're going to see some big things for Bitcoin. Sam wants to know if I personally hold any Chinese stocks. We just talked about that in the live stream, folks. Just talked a lot about that. I do own Alibaba. I do own Didi. Just started buying them here in January and February of this year. So cost basis is around $88 for Alibaba. I sold some covered calls against the DD position, so my cost basis is about $1.70 there. I think without the regulatory nightmare that these things have been going through over the last year, I think they are very good stocks. I think they're value stocks, and I think they could do well. What else? Are you buying any metals companies? I'm not buying any metals companies right now. Haven't looked at those in a while. What about Expedia? So the Quags wants to know about Expedia. Again, folks, if you start with that bigger picture idea, those trends that we're seeing, and one of them in particular, the travel and leisure coming back, again, ask anybody what they want to do now that they're off lockdown, that they're getting out of their house and things are getting kind of back to normal. They're going to say travel. A lot of people, that's the top on their list for things to do. They're going to travel. They're going to start staying in these hotels. They're going to start booking on Expedia and hotels.com and things like that. So I think, you've already seen a lot of these stocks rebound on that trend, but I think you still got some good upside in some of those travel and leisure stocks. So that theme. So take the big pictures, take the big trends, and then drill down into the individual stocks you like there. Ether. Thank you, Microsoft using Ethereum. Any thoughts on Clove? Ricky wants to know about Clove, CLOV. That's, there are still some of these SPAC stocks that went that issued shares through a SPAC, through an SBAC that I still won't touch. Clove, I think, is probably one of them. I think is, for the longest time, this thing was just trading at insane, crazy valuations. And we have seen it, Clover Health, we have seen it come down quite a bit. Now it's down 3% so far today. You can see the 1-year chart. It just looks, well, look at the max chart. It is nothing but down from $10 when it did issue shares. It was up as high as 16 here. And what I do, anytime I'm looking at these growth stocks, okay, these stocks that have come to market in the last couple of years, either through an IPO, through an SBAC, I immediately go to the price to sales. Okay, and actually this isn't bad. 1 times price to sales ratio. If this is anything over 10, I won't even look at the stock. Okay, it's just an immediate no-go. It's way too overvalued. Price to sales over 10 is something that, even if a stock is doubling its revenue every year, it's still valued too expensively to really get serious about for me. But price to sales of 1.05, not bad right there. I would want to check the revenue growth. So revenue growth is good. I would want to go to financials and really look at what the company is doing. So over the trailing 12 months, it's grown to $1.5 billion in sales from zero. It was 462,000 in 2019. So strong revenue growth. I would really have to get to know this company a little bit better, because I know this is one of those that did come to market through a SPAC, through an SBAC. Terrifically too high valued. It's now down quite a bit, obviously down from $10 down to $3.40. So I would want to take more time to look at that. I just really haven't looked at that since they started trading at those kind of insane values. What else? Thoughts on what about SoFi? So Miguel wants to know about SoFi Technologies, ticker SOFI. Again, this is one I'm going to talk about in Friday's video. It's one of the 7 largest holdings that I'm holding right now. One of the 7 largest stocks. And that means it's at least over $25,000 in my portfolio. It's probably closer to about 35 or 40,000. SoFi is the future of banking, okay, and it has got a huge lead on these other fintech companies, these other virtual online banks, because it has a banking license, okay. SoFi acquired a traditional bank last year. I think that was like Golden Pacific or something. And they got that banking license from that acquisition. Okay, so now what you see with a lot of these online banks, a lot of these pure virtual, fintech companies, they don't have a banking license. So one, they can't offer some of those services like savings, like checking. They don't have access to those rock bottom interest rates that the traditional banks have access to. Now, because SoFi does have that, they have access to that. They have a huge lead in products, services, rates against some of these other fintech companies, some of these other online banks. So that's one thing. With SoFi as well, SoFi is kind of there's a big catalyst coming up whether the student loan moratorium is going to be renewed or not. Okay, that expires, I think, in May. It's been for like the last 2 years. People haven't had to pay their federal student loans. They haven't had to start paying those back. SoFi is a big producer in student loans. They started out as a student loan refinancing company. Okay, so they've still got a lot of business in that, and that's hurt them. Over the last 2 years, people haven't been paying their student loans. People haven't really been taking out student loans as much as they were either, and that's really where you see the weakness in SoFi. Okay, in shares of SoFi. If that moratorium gets lifted, and there's really no reason people shouldn't be paying off their student loans. Okay, I've got student loans. I haven't been paying them because I don't have to, because the government says, hey, take some time. Don't pay these student loans. My interest rate on student loans is 2.7%, right? Because I was, right in that period back in 2003, 2005, when they were rock bottom rates. So I'm not paying my student loans if I don't have to, So as soon as people have to start paying back student loans, I think you're going to see SoFi really jump. I think you're going to see the stock price really take off. And then longer term, it is a growth stock. It is a great stock for that future of banking. So I like SoFi. I've got a lot of money in it as well. CCL cruise still risky. Chris wants to know about CCL, so Carnival or the cruise industry, and whether it's still risky. That's one I've struggled with. The Carnival or the cruise lines. Carnival, Norwegian, things like that. It should be part of that theme, part of that travel theme. But you really have to worry about these. You really have to worry about the debt that they had to put on through the pandemic just to survive. You have to worry about, if they're able to operate even with the, a lot of these, they have to shut down if they get like one case or a couple of cases of COVID on the ship. Okay, so it's a very hard business model to operate. Even as COVID cases come down, even as we move on to some kind of normal, they're still going to be hurting. And I think those debt loads that we saw over the last couple of years are going to make it really hard to become profitable again for these companies. So, if you've got any great trading experience or you want to trade these stocks, then maybe you can trade them. I wouldn't touch them as a long-term investor because there's just too much risk. There's just too much risk for the potential return in these over the long term. And I don't need the stress. Okay, for a lot of these, you gotta make the distinction between stress, risk, and return. Okay, and you can get some great deals in a lot of other stocks. You don't need to take so much risk in these stocks that you don't know if that debt load is going to really make the business impossible over the next couple of years. So I would stay away. Again, if you want to trade them, then you can trade them. I'm sure there's some returns there, available for traders, but you really have to worry about that longer term picture. Okay. Well, we are heading on an hour and a half into this live stream. My voice is starting to give out, so I'm going to cut it off this. If I didn't get to your question, go ahead and ask it in the comments below. Be sure to sign up for the Bowtie newsletter, the Bowtie Weekly, every week completely free on Sunday night before the market opens. I'm going to send you a newsletter tracking the stock market news, what to watch that week, the stocks to watch. So just something I like to do for all you out there in the nation. Make sure you click on that sign up link in the video description below and check that out. And I will see you in tomorrow's video.